Hi, I'm Doug Porter, Chief Economist with the Bank of Montreal with the monthly economic commentary. Definitely the biggest change that we've seen in recent weeks is the whole conversation around Canadian interest rates. Basically from a standing start and really no change in rates for the past couple of years. There's now very much anticipation that the Bank of Canada could raise interest rates as early as the month of July. And if not in July, then we see a rate hike later on this year. Now, what spurred this change in the bank's view of the economy? And it's simply that we've actually had a very nice upward pleasant surprise in Canadian growth over the past year, much to the surprise of forecasters like myself. It now looks like the Canadian economy will grow almost 3% this year versus expectations of closer to 2% at the start of the year. And really Canada stands alone in the industrialized world is significantly surprising to the high side. As well, we've also started to see the unemployment rate coming down in Canada after being stuck at 7% for years. It has started to drift lower. And the last reason why the Bank of Canada is now looking at the potential for higher interest rates is because the housing market nationally remains quite robust. Now, of course, that's not true in every single city, and it's spectacularly true in places like Toronto. But overall, when we look at the housing market as a whole through the country, it is a little bit too hot for the bank's comfort, and a primary reason why the bank is now looking at long last at raising interest rates for the first time in 7 years. So what does this mean for the Canadian dollar? Well, we've already seen it in recent weeks. After hitting its lowest level in many, many months, the Canadian dollar has come bouncing back to more than 75 cents. We, for one, though, happen to believe that the Canadian dollar is probably about as high as it's going to get for a period of time. There's still a number of factors working against a much stronger Canadian dollar. First of all, oil prices are really having trouble breaking out of the sort of low $40 range. And unless and until oil prices move consistently above $50 a barrel, it's tough to see the Canadian dollar really strengthening a whole lot further from here. We also happen to believe that the market is actually underestimating the amount of interest rate increases that we're going to see out of the U.S. Federal Reserve over the next year. Yes, the Fed did go again in June. That was the fourth interest rate increase that we've seen this cycle, but we certainly don't think that's the end of the story by any means. We're expecting actually, in fact, another full percentage point increase in the U.S. Fed funds rate by the end of 2018, and we think to a large extent that's not completely priced into the foreign exchange market. As the market builds that in, we think that will also cap the recent strength that we've seen in the Canadian dollar. That's this month's economic commentary. Thank you very much.